welcome to Interactive Investors Super 60 Fund Finder.
Just like a balanced diet, a balanced portfolio is good for your long-term well-being. In the investment world, striking the right balance involves buying a mixture of different investment types, shares, bonds, property, and alternative investments. Doing so gives investors diversification, which helps to reduce risk. How you mix and match between these different investment types depends on a number of factors, including your age and your attitude to risk. One option is to build the portfolio yourself. In Interactive Investors Super 60 list, we have funds, investment trusts, index funds and exchange traded funds for all the major asset classes, shares, bonds, property. We also have some alternative investment ideas for infrastructure and commodities. Check out our core and adventurous selections. Our core funds tend to invest in larger companies, so could be viewed as a lower risk option. Our adventurous funds, on the other hand, are likely to be higher risk due to the way in which the fund invests. Another option is to consider outsourcing the investment decision making to a multi-asset fund, which will give you instant diversification. In our Super 60 list, there are 3 passively managed funds by Vanguard, 3 Vanguard Life Strategy funds, which have 20%, 60% and 80% invested in shares. We also have 3 actively managed multi-asset funds. These are Capital Gearing, Artemis Monthly Distribution and Fidelity Multi-Asset Income.
The big question.
Bond markets have performed strongly since the financial crisis, mainly boosted by the government and central bank policies, such as low interest rates and quantitative easing. While bonds have provided investors with strong capital gains, bond yields have been pushed to historical lows, making them unattractive for income investors. However, as we move into an environment where the US Federal Reserve may start to raise interest rates in response to rising inflation expectations, investors are concerned that this could cause bond prices to fall and yields to rise. Therefore, now more than ever, investors need to look beyond traditional safe bonds and adopt a more flexible approach to address rising rates and inflation concerns. Different bonds react differently to rising interest rates. For example, a 1% rise in yields will have much larger impact on the price of a longer maturity government bonds compared to a shorter maturity bonds. Furthermore, investment grade, high yield and emerging market bonds are considered to be less sensitive to interest rates than government bonds. Bonds continue to offer investors the benefits of diversification away from equities, along with a stable income and relatively low volatility. However, given the low yield environment, investors must make their bond funds work a bit harder than they have done in the past.